Hi, this is Darshan Bhatt from Glovista Investments with our market outlook for the month of April 2022. The first quarter has witnessed the sharpest volatility spike in financial markets since the first quarter of 2020. Despite a strong performance in March, the S&P 500 and the Nasdaq index declined by 4.95% and 9.08% respectively for the quarter. Such price declines have been led by number one, the ongoing Ukraine-Russia war. Number two, the first policy rate hike by the US since 2018, combined with a sustained hawkish outlook by Fed, which has led to a persistently high volatility in fixed income market with knock-on effects on equity market volatility. And three, an unexpected surge in lockdowns out of China and other non-Asian economies courtesy of an Omicron virus strain. Such macro and policy developments have led to downward revisions of economic growth forecasts and upward revisions to inflation projections over a longer term and even more hawkish US Federal Reserve. Such dynamics has led to investor concerns surrounding a stagflationary environment in the balance of the year. Such environments are equity market unfriendly as they are normally associated with equity multiple compressions. As we look ahead, we believe the global economic expansion will extend well into 2022, averting recession, primarily owing to number one, the labor market resiliency, number two, a proactive fiscal stimulus being provided on the consumption side, number three, continued loose financial conditions despite rate hikes being priced in the US, UK, and Europe. And number four, still manageable energy and food consumption expenditure levels within the household's consumption baskets. From a market perspective, given equities' considerably cheaper valuation versus fixed income, we believe equities will outperform both bonds and cash over the balance of the year. However, given our outlook for a continued rate increases out of the US and below trend economic growth in 2022, we continue to favor value-oriented factors both in equities and fixed income. Within our emerging market portfolios, we continue to prefer Latin America owing to cheap relative valuations, strong top line and bottom line growth outlooks, as well as under ownership status. In addition, in our view, the recent market developments merit an upgrade to emerging Asia as the recent spike in equity risk premium will reverse over the medium term. From a macroeconomic calendar perspective, we believe over the next few weeks, the market's focus will primarily center on the beginning of the Q1 earnings season, and number two, global activity matrix, particularly focused on the global consumption sector. Thank you for listening and good luck.